Hi, John.
How are you?
Very good. And you? Yeah, good to see you. How is Paris? I enjoy it.
Lovely city, wonderful weather. Couldn't ask for more.
For sure. The Paris is always cool. You know, this atmosphere, John, that you feel here, you can't experience this at any other city.
It is unique indeed.
Okay, John, I would like to ask you a few questions that now it's very trendy and everyone is wondering what happened to all these banks that were dealing with the crypto-related companies, and not only with them, but also with the startups. And now a lot of rumors about the bank run, a lot of things are happening, a lot of journalists are issuing the new posts about all these events. So could you please elaborate and explain us what is really happening right now in the market and what happened to those banks? And what does mean bank run?
Sure. Well, I think it's one of the hottest topics in the industry at the moment, in the capital markets in particular. It is unfortunate. Silicon Valley in particular, a business, a bank, startups, has been hit with what we know as a bank run. Why? This particular bank has been under scrutiny, specifically after their earnings were released in the forecast for the upcoming quarters. They were revised and they were simply not what the market was looking for. It has triggered panic and unfortunately led them to that well-known bank run. What is a bank run in the simplistic way is multiple investors, multiple depositors to be precise, decide to withdraw their funds all at once. So what happened to them is this was an institution that was well capitalized to some extent, but they had to sell some of their bonds in order to cover some of those withdrawal requests at a financial loss. Remember the basic principle that when you have interest rates going higher, you have bond price valuation going down. So they had no choice but to absorb a loss that they wouldn't have taken otherwise.
And basically, John, they bought those bonds when the interest rate was so low and they had to buy so long bonds in order to at least generate some interest rate.
Of course, it's a common practice by any bank globally speaking. I mean, don't forget, almost every institution does put some of their holdings into a revenue stream, eggs, in addition to lending that capital that they obtain from depositors over the years. There's also a very interesting point to highlight. SV, or Silicon Valley in particular, they were able to attract 3 times the deposits that a more conventional bank like JP Morgan, Morgan Stanley, and so forth were capable to obtain historically. So that on itself triggered a large increase in their holdings, but made them systemically important to some.
So they became 16th bank in the United States.
And after their fiasco, then we have the next case. You know, the market shorted their stock price dropped extremely fast, and they lost most of their valuation.
Oh my God, John. So basically these trading firms, hedge funds, systematic traders, basically they started selling the stocks of that bank, of Silicon Valley Bank and the other banks, just because the market was expecting that their profit would be higher than the previous year. And what was the potential profit of this Silicon Valley Bank? I mean, it's supposed to be higher than the previous year, and eventually it appears that it's lower, or it was actually negative.
So basically, just like anyone in the crypto space, you can understand that they were serving a lot of the crypto entities. So their earnings they missed estimates as we know it. In other words, they didn't reach targets, and this triggers panic at all times. But Arthur, if you think about it, look what's happened to the winter crypto era in the last few months, close to a year. This has an impact, and there are ramifications in any business, no matter what.
I see. So, John, let's just, in a simplistic terms, the bank presented their results, saying that, okay, guys, my results of the previous year is a bit worse than the previous year. Then hedge funds started selling the stocks. So they went actually short positions. That created the market impact on my valuation of the stocks.
So basically, the way we can think of it is as follows. You have a business that is supposed to perform based on previous forecasts as X. When you reach the point of reporting, the earnings didn't meet expectations, the market shorts your stock, people panic, investors, depositors, particularly, they want to withdraw their funds because they're not sure about your future performance. Your stock price drops, you have a bank run, which means everybody wants their money back. You have no choice but to sell at a discount.
Because all my reserves, they were in bonds because I wanted to generate some revenue. And at that time when I bought this bond, the interest rate was so low, that's why I had to buy very long bonds. But John, it's not actually fair, right? For example, right now, if you want to buy those bonds, your interest rate for the much shorter period of time would be much higher than Silicon Valley bought these bonds. The market makers or treasury, they do not try to evaluate when the Federal Reserve increase interest rate.
Well, the United States as an economy at the moment is in a very tough situation, one could say, meaning inflation was running very high. The way that the Fed was trying to contain inflation is by increasing rates quite fast. Obviously, there are repercussions, like in any actions one must take. Of course, if we look back a year ago, the bonds that they were holding, they looked very attractive. This bank run is what really hurt them, and it's all about sentiment. This is the danger at these times.
So, John, actually, basically, nevertheless, the Silicon Valley Bank on the papers was super well capitalized, and they had all the reserves. They could cover any deposits, right? Any withdrawal. They could actually survive through this bank run. But because they had to sell all their bonds with the huge discount, because nobody was willing to buy the bonds, that they can buy better new bonds with the much higher interest rate.
Absolutely, and that's the whole point. It's a mixture of different elements. You have the disappointment in performance, you have the bank run, and then ultimately the financial loss from your holdings. And this is a ripple effect. Once element triggers, the next one follows.
Okay, and then what happened to Signature Bank? It was the same or not? Because Signature Bank, I saw their statement, and as of 31st of December 2022, basically they had 86 billion deposits, and their assets were 116, which extremely exceed their liabilities. So what happened to them? Why actually Fed Reserve decided to close down or shut down the Signature Bank?
All I can say is a controversial time in which we're living. In a speculation that Signature was taken by FDIC upon the request of the government purely on the basis of stopping contagion into other banks. However, there seems to be some connection with the fact that Signature serves crypto businesses, and they were concerned that this is the reason why this bank was next to fail. The FDI, by coming in, they guaranteed that all depositors receive their funds. This is an unfortunate situation to see an institution that was doing fairly well being taken by one of the government entities. It's something we don't see very frequently. I think they were one of the third largest banks in history of the United States that has gone down based on their size.
2008, I guess, yeah?
It's
Unbelievable.
extremely
Unbelievable.
And what is really incredible is how these events took place over the weekend when the markets were closed. And now this weekend, we see Credit Suisse being taken over by UBS.
It's a tremendous organization. How it could happen to them, actually?
So you see, based on what's been taking place in the banking sector recently, not only with Signature in Silicon Valley, now we have the latest victim, Credit Suisse, a business that it has been in operation for over 100 years. It is a testament success in the banking sector, and yet it comes down on its knees. Why? Credit Suisse has had some recent challenges with their financials. They were scrutinized by their auditor, and they were not satisfied with the information they were providing. They haven't reported earnings yet, although they were scheduled to do so before. This, in the time of panic, obviously, they experienced a very similar case to previous banks where they had a bank run, where depositors wanted their money back, and they found themselves with a very heavy loss in terms of their stock. Their stock was trading at a certain premium. Now we've seen how it just collapsed. And one of the saddest situations I've seen in recent times, again, happened this weekend, where the bank was sold as per government's instructions to their rival UBS, basically for a fraction of where the bank was trading.
So they took it over.
They took over and they took it at a discount. Basically a fraction of what it was priced just a week ago.
Wow. So, and basically, I think the discount was very sufficient, right?
It is a substantial loss for investors.
And that's how they play with their reportings, how they play with the open market.
Well, don't forget that the banks now are under tremendous scrutiny. Central banks around the world have emphasized on the importance of transparency, especially since, so we always have to remember, those standards that were improved back then are now the tools for some of the central banks to control contagious situations like the ones we experienced this weekend. What the Swiss National Bank is trying to do is to avoid this problem to spill over other banks. And globally speaking, well, I think we're all at risk at the moment, not knowing who is the next bank that may come into a problem.
Who is on the list? It's Silicon Valley Bank, Silvergate Bank. By the way, what happened to them? They decided to close down their operations by themselves, right? But of course, I think they were forced to do so. They just didn't want to disclose this, and they wanted to present the case that they took that decision to close down operations.
It's one of those things we will not know for the time being, but everything comes to light in due time. I do believe on a personal level that that's a case of they were in financial trouble. They knew it. They knew there was no way to raise more capital and try to save the bank, so they decided to close on their own initiative, rather than being a case of, for example, Credit Suisse, where there's a central bank's intervention, or in the United States, the other case of Signature Bank when the government came in.
And Silvergate Bank was serving Binance, and especially the Signet. It's the network where the transactions were happening without any delay, 24/7. And one of the recent events that United States, they actually prohibit to Paxos company to continue support the Binance USD, which was based on the Paxos platform. That's actually made some impact on the Silvergate Bank, I guess. What do you think, John?
I think there's a connection among all these different topics. Unfortunately, I think the banking sector has affected some of the crypto businesses that are out there trying to innovate and come up with new solutions.
You know, John, what I'm also wondering about, it's about this hedge fund that made a lot of money on this bank run. how they actually, what is their view on this? And is it actually legal to start selling to short all those banking sector stocks in order to make money, while the companies, especially who had the bank accounts within the Silicon Valley Bank, Signatures, the Silvergate, they were suffering, especially over the weekend, when some of them, they even send the emails that perhaps on Monday they will not be able to pay salary, tax, rents, and other operational expenses. So how these hedge funds, so they made on that event, they made a lot of money. What is their views on this, John?
May impact the price stock according to the size of their operation. So if we take an example, businesses out there who short stock, well, it's not against the law. It's never been against the law unless there's a restriction on that particular security. I think some of the hedge funds got into the market before these events unfolded, and it was all about market sentiment. The more I knew that you were shorting the market if you were a hedge fund, I'd probably follow suit, because we all knew that there will be an impact in the long run. So from a legality standpoint, it's totally legal. You can buy, you can go long, you can go short in the market. It's not an issue. But of course, when everyone is doing the same, you're gonna have a ripple effect on that price. That's what we have seen in recent days.
Essentially, John, there are opportunities because the whole banking sector in red zone, and basically especially for the traders and prop trading firms, it's a real opportunity.
I believe we have seen close to near the bottom. I've seen that the market has recovered yesterday slightly, but it's been a bloodshed over the last 2 weeks without the slightest doubt.
I see. Okay, here, John, I have another question. It's also very important. What can you say about the recent event that happened to USDC? The company is known as a Circle, and USDC, this is the most popular, the regulated stablecoin among all other stablecoins. So comparing to the USDT, which is unregulated stablecoin, the same equal assets as a circulation of the USDT, but still the most transparent, it still remain USDC as a Circle. And the recent events with the banks caused this depegged situation with the USDC stablecoin. Could you please explain us what really happened and how the market recovered then, and what the traders or just users who hold the USDC because they don't want to invest into Bitcoin, they just want to see it in the stable coins in order to have a liquidity, to have a cash. So what would be your vision on this?
I think what has taken place is a historic move over 2 weeks ago or 2 weekends ago, because the concept, the philosophy of a stable coin and being pegged to the dollar 1-to-1 was basically the foundation so that many businesses would come, especially corporates and institutional world kind of guys, park their funds in a stable coin, yet a digital currency. But what we never thought was going to take place is the depegging aspect of it. And why? When you have the assurance and when you have the capability to demonstrate that the actual coin is 1-to-1, the risk was viewed as very low and the probability of depegging was very low. But the impact of the bank, where in this particular case, USDC or Circle had some of the funds allocated, I guess, close to
2 billions, right?
I would say quite sad. The announcement was close to 2.7, as far as I recall. This is a large amount of capital that triggered the depegging because investors got nervous when they learned about this, and it took place over the weekend, which obviously you and I know that on the weekend there's less liquidity, less market participants. So the depegging takes place over the weekend. Once the market recovers on Monday, is primarily due to the news that particular bank where they had a risk exposure towards, they recovered those funds.
I see. Yeah, but as Also, you know, John, we saw the trigger, the investors, they started selling USDC and stable coins and buying Bitcoin. That's what we see now. Bitcoin is more than 28.
That's the new trend. Obviously,
Just for a week, right? Just for a week.
over the last 10 days, we've seen price action to the upside very strongly.
So what do you think? Is it, does it mean that crypto spring just has started?
I think the next round of events will dictate us on where we're heading. I think it's a very different dynamic from the winter experience we saw in recent weeks and months.
I see. Yeah, but it's very interesting, John, you know, and again, as we were referring in our previous videos, that you always have to be very careful with the counterparty risk. You should never put all the eggs in one basket. Never.
I think it's one of the oldest and most important concepts in business, diversification. That's the real key. Always keeping track of current daily events lead you to better educated decision in that process of diversification.
Thank you, John. Thank you. Now it's much more clear. And just to sum it up, now let's just share maybe our small opinion how to deal with that. So guys, we would advise you to be very careful to assess in a very detailed way your counterparty risk, to always take into consideration that nevertheless that you deal with the humongous brokers or banks, there's still a chance, a probability to have some potential challenges. So that's why just be very careful, and especially we recommend you to establish within your company risk committee who will try to assess the risk, to try to analyze all the statements, all the reports, in order to provide you some sort of the predictions that based on what you can make your decisions, right?
Absolutely. I think having a conservative approach at times, it's also a long-term vision for your business. The safer, the better.
Yeah, thank you very much, guys, and thank you for watching us. And of course, any of your questions related to capital markets will be welcoming, and we will be delighted to answer them all. Thank you very much. And thank you, John, again.
Thank you. Great seeing you in Paris.
Enjoy in Paris. Take care. Thank you.